Time now for your call of the day, and today it is on the banks. Financials have surged more than 9% as a group and 0.5% in the past month. But Societe Generale says it's time for investors to ring the register on gains in shares of two of the biggest names, Goldman Sachs and Morgan Stanley. The analyst at SocGen downgrading both to a sell rating. The market ignoring those calls today. Both stocks are actually higher. Goldman Sachs is up 19% so far this year. Stephen Weiss, what do you think? They downgrade it, the market ignores it.
Yeah, I think they should, frankly.
Ignore it.
Yeah, I mean, look, I like when analysts come out with sell calls. You see so few of them. We saw one sell rating on GE, which I would argue should have a lot more. But here's the story. First of all, he points out the one MBD, the Malaysian scandal, where it's alleged that the Malaysians want $6 billion from Goldman. That remains to be seen. That's going to play out over the long haul. But the bottom line in these companies is they're two exceptionally well-managed companies. David Solomon had been unproven the CEO role only because he just took it. But I think he's going to do an excellent job. So I wouldn't be a seller. Now, on the other hand, I'm not so sure I'd be a buyer of any of the financials, given where rates are and how rates continue to be low. And as we've seen, there's such a high correlation to all these financials to rates. I own Bank America. You know, I'm happy holding it. I'm not looking to buy any more, and I'm not looking to sell it. It's just there. It's not going to be a great performing sector.
I don't understand this call at all. First of all, I'm not a big believer in selling or shorting equity names, but I believe Morgan Stanley's trading 42 right now. He's got a $40 price target on it. I'm not necessarily sure what I'm supposed to be doing with that.
Just sell it and put your money someplace else because it had a big January, I think.
With a $40 price target. If you're going to give me a sell call, and the price is 42, I need a $30 price target. I don't need a price target $2 below.
I'll tell you what's really going on here, and this is not going to be popular, but I'm going to say it anyway. You cannot take macroeconomic commentary from Europe about U.S. situations and extrapolate that into trades. SocGen's got this overarching Ice Age thesis. They've been saying the world's going to come to an end for the last 10 years. They have this guy, Albert Edwards, whom I'm convinced is more of a performance artist than an actual investment strategist, who has literally been predicting the end of the world since my bar mitzvah. I have no idea how much of a connection there is between individual equity name research and the bile that he's been pumping out about the U.S. economy, the global economy, the debt situation, the banking system. It's on and on and on. And maybe this will be the time. Maybe this will be the time, and this clip will be infamous, and they'll play it to embarrass me in 6 months. Maybe this will be the time that the Ice Age comes. I don't know, but I'm just going to tell you that as a general rule, you don't want to take this kind of thing where, well, the credit cycle's already turning and this is all going to fall off a cliff. You have to go back and look. Have they been saying this every year? And in the case of SocGen, they have. So maybe they're right this time, but it has not been good advice.
And Pete, listen, and I think I've interviewed Mr. Evans a few times.
Shout to SocGen, though. No disrespect.
Yeah, well,
I'm just telling you how I see it.
But here's
I tell it how I live it.
Peace and love.
You're the worst of the worst. No disrespect. Pete, here we go. Here's what they're calling for. What they're looking for is Federal Reserve accommodation. Basically, the analyst is saying until we see rate cuts, which is kind of the opposite of what we think about.
Made no sense when I read that, by the way.
Yeah. No, well, I mean, there are some people that are calling for rate cuts. I don't understand it.
That doesn't make sense.
I get that. I get that. They're talking about expansion of global economies. What do you think, Pete?
Well, you know, I think particularly in these names, especially Goldman Sachs, I think you're talking about a company that really, they make their money in active markets, and it's been a very active market. I think this year is going to be very active. I think we're going to see volatility all over the place, Sully. So for those reasons, I think that a Goldman Sachs and Morgan Stanley should perform well. Now, I think Morgan Stanley is very much going to trade where the S&P 500 trades, and it's going to kind of track along somewhat with that. On the other side, I think Goldman Sachs, because of it was so oversold, and that's why I think we've seen this radical move to the upside that we're seeing where it's trading now closer to $200 a share. I still think that there's plenty more to go for Goldman Sachs if the market continues to be what I think it's going to be, which is very volatile, very active, very stock specific. That is exactly what they're looking for, and I think that's the right place to be right now.
Yeah, what I would just say to that is that if you look at what the bank said in earnings season, it was the consumer side of the business that was actually very strong. At CFRA, we're underweight the financial sector because of a lot of things you guys talked about here. We just don't see the Fed not moving isn't going to be helpful to the bank's loan growth is still going to be probably pretty subdued. The capital markets remain a question. So we're sitting on the sideline.